Hey YouTube, I'm Jimmy. In this video, I'm going to walk through my analysis of Chevron, ticker symbol CVX. This continues our series where we're analyzing all 30 stocks in the Dow Jones Industrial Average with the ultimate goal of trying to take those companies and trying to build a great portfolio. This is the 6th video in that series. You can see a link to the playlist for all 6 of those videos below. Another thing I'm trying to do is I'm trying to use different ways of analyzing and valuing companies based on individual situations. See, I wouldn't want anybody to go out and invest in a company because we here at Learn to Invest, the community, say we think it's a good buy. What I'm really hoping for is that by going through each company in the Dow, we get exposed to different ways of analyzing and valuing companies. Then we take what we learn in various situations and we apply that to our own research techniques. Okay, so now let's get started with Chevron. And as you may have guessed from the intro, I'm going to do things slightly different with this video. So what I'm going to do with this one is I'm going to focus more on competitor analysis and how they compare to Chevron. Now, whenever I do research, I always try to look at competitors since that I think it's a great way to see how a company stands out or how it differs from their competitors and what type of advantage or disadvantage that company might have. And oftentimes when I invest in a company, or at least when I start researching a company, I end up investing in one of their competitors because it's a great way to get exposed to the entire industry, see who has a competitive advantage over their peers. But to prevent these videos from being crazy long, I try to summarize and present only the key points. So you may notice in this video, I'll spend more time than I normally do saying, okay, here's what Chevron does, and here's what this competitor does or that competitor does. But it's important to know that whenever I do research, this is how I normally think about it. I see what a company does, and then I say, how do the competitors do it? How does their performance stack up to what the competition does? Okay, so Chevron is an integrated oil and gas company. And an integrated oil and gas company is essentially a company that finds, produces, refines, and distributes oil and gas. Competitors are companies like Exxon, BP, Total, and Royal Dutch Shell. Okay, now if we look at the energy industry as a whole, it can broadly be broken into 3 phases: upstream, midstream, and downstream. Upstream is when they take oil and gas out of the ground. Midstream is when they take it and they ship it via pipeline or tankers or whatever they use. And downstream is when they refine it and sell it. Chevron mostly sticks in upstream and downstream. So here's a chart of revenue going back to 2008. Okay, it's been a bit volatile, but we can also break down this revenue a bit further. Blue is downstream and orange is upstream. So it looks like downstream dominates the revenue. The question is that normal? Well, let's go find out. So here's ExxonMobil's revenue for the same time period. Okay, this seems quite volatile as well. Here's the revenue broken down. Okay, first off, let's look at their breakdown. It's similar in that downstream dominates the revenue, but they also have another category they call chemicals. Now, back in 2009, Chevron actually had a category that they called chemicals as well, but it represented just 1% of revenue, and they eventually dropped it in 2010 completely. So for our analysis of Chevron, chemicals aren't going to play a huge role, but either way, I think it's interesting to see how ExxonMobil does it. Now, what about another company? Let's look at Royal Dutch Shell. So Shell, too, has some volatility since 2008. Now, I think it's safe to say that volatility was fairly widespread throughout the industry. Now, I'm going to stick with just 2 competitors to try to keep this video to a reasonable length. But if we were going to keep going, and what if we happened to find a company that didn't have the volatility in revenue that everybody else had? Well, my question would be, how? What did they do differently? And then perhaps there would be something interesting about that company that would make for a great investment. That'd be something that we want to dig into. But in our case, we've looked through a few of them, and it looks like volatility is happening from the companies we've looked at. And now what about Shell's breakdown? And yes, once again, it looks similar. And interestingly, instead of chemicals, Shell has a category for integrated gas. So I went ahead and dug into the differences between Chevron's downstream and upstream only, and ExxonMobil's has chemicals added, and then Shell has added integrated gas. And interestingly, each of the 3 companies each participated in chemicals, integrated gas, upstream, downstream. So I really think it's just a breakdown thing of how they're separating the numbers for us, the investor. And since the numbers were easily accessible this way, this is how I'm presenting them in the chart. But just as an example, Shell, in their recent management discussion and analysis, listed chemicals as a key growth segment for their business. So, although they don't have chemicals listed as a category, it is something that they're all participating in. So, we'll keep that in the back of our mind. Now, if you're wondering what chemicals is, Chevron, who also has chemicals as a source of revenue, but it's not broken out separately, well, they define it as additives for lubricating oils and fuels, and integrated gas for Shell is listed as LNG activities, which is liquefied natural gas, and GTL fuels, which is gas to liquids. Now, Shell also includes new energies in their integrated gas segment, which includes things like wind and solar, biofuels, and hydrogen, things like that. Okay, moving on to profits. Here's Chevron's profits going back to 2008. Now, here's something very interesting. Look at which category is leading the way most of the time. Upstream. So, looking back at 2011, here on the revenue chart, upstream accounted for just 13% of total revenue, while back on the profit chart, upstream accounted for 92% of profit during that same year. When we jump over to ExxonMobil, we see that profits are once again dominated by upstream. Shell, same thing. Upstream leads the way. So now I realize that upstream must have better margins than downstream. And that seems to be true across the board. Great. Now we know something new about the industry. But I don't necessarily know if Chevron is good as a potential investment compared to their peers. So for me, the real question is, who has better margins? So here's a chart for all three companies' downstream margins. I took the average of this 10-year period to try to make it a bit easier to compare. And as we can see, Chevron actually has the best downstream average. Although, if we look at it, we can tell visually that 2015 looked to be an unusual year, and I was curious what would happen if we eliminated 2015, so I did that for all three companies, leaving us with just 9 years, and here's what the 9-year average looked like. Well, as you can tell, Chevron still has the lead when it comes to margins. Okay, now let's jump over to upstream. Okay, there are a few interesting things in this chart. First, although their margins for upstream is great, we can see that they're quite volatile. When oil crashed back in 2015, you could see that both Shell and Chevron were losing money. And in 2016, Exxon was barely positive. Now, if we add the averages for this 10 years, we'll see that Exxon is in first with almost 61% margins, and Chevron is second with about 48%. Okay, if we do what we did last time and kill 2015, we can see that all averages move higher, but the same order remains. So now I think the next logical question is, what happens when we look at overall margins? Margins are a very big driver as to what multiple works best when trying to come up with a valuation. So I think it's important to look at margins as a whole. This chart here, this shows the 10-year average for each of these companies. Exxon is the best, then Chevron, then Shell. Okay, this is good information, but we all know that Wall Street and investing in general is very much a what have you done for me lately type of business. With that in mind, what happens if we shorten up the time frame? Instead of using the past 10 years, what if we look at the past 8 quarters? And we can see that Exxon is in the lead still, but just barely. And if we switch the last 8 quarters, which is 2 years, to just 1 year, which is the past 4 quarters, we'll see that Chevron now has the best margins. Now, let's try to jump to valuation. Okay, using a PE multiple for oil and gas companies can be tricky, because if oil and gas prices were to crash like they did back in 2015, then PE becomes useless. You need to have profits for PE to make sense. And usually, you want somewhat predictable profits for PE to work well. Now, one method that's popular among analysts, and it works well for energy companies, is something called EV to EBITDA. EV is short for enterprise value, and EBITDA is short for earnings before interest, taxes, depreciation, and amortization. Sometimes, you'll also see analysts use, specifically for energy companies, EBITDAX. EBITDAX is just like EBITDA, except they add an X to the end, and the X stands for exploration. And this could be quite good for accounting for exploration expenses, but in our case, we're going to use EBITDA. And that's mostly because their revenue is largely driven by both downstream and upstream, not just upstream. So as of today, these are the forward EV to EBITDA multiples looking out the next 12 months. And frankly, I was a bit surprised to see that Exxon is trading at such a premium to Chevron. Now, if we add their 3-year historical average for each of the companies, we can see that they're all trading at a discount to that average. So now the question for us is, where do we believe Chevron should be trading? Should they be valued at Exxon's 7.2 times next year's EBITDA, or even Exxon's 3-year average? Or should we stick with their own 7 times average? For me, I go to this chart. This chart shows the company profit margins going back to 2008. And if you look at the end of 2015 and the start of 2016, we'll see that Shell's profits went negative, and so did Chevron's. But during that same time period, Exxon didn't lose money. This tells me that Exxon seems to have a bit more safety built into their business when compared to Chevron or Shell. So, with that in mind, I believe that the premium that Exxon is trading at is probably deserved. There's a certain safety net there in many investors' minds. So for us, I think it's best if we still use Chevron's own historical average. I personally think the 3-year average is perfectly reasonable to use, but I wanted to make sure there are no crazy outliers, so I went and double-checked their 1-year and 5-year average, and all of them were trading mid-6 multiples. Since margins have improved so nicely over the past year, I think the high end of this average is quite fair from a valuation perspective. So, what I did is I went ahead and applied a 6.75 times multiple to next 12 months EBITDA. And when I calculated that, we end up with $179 fair value. Compare that with today's price of $124 a share, and Chevron looks like it's a pretty good value today. So now what if we wanted to be a bit more conservative and we didn't want to use a multiple of 6.75 times? Well, what if we were to apply, let's say, the low end of that? Let's say 6 times. And if we were to apply 6 times to projected EBITDA going out the next 12 months, our fair value falls down to $161. But this still isn't too bad compared to the $124 price today. So overall, I think that Chevron still has a pretty good chance of making our ideal portfolio. Exxon is also part of the Dow, so I think it's going to be interesting when we get to that video, and in that video we'll probably spend a bit less time comparing it to the industry and more time on things like oil and gas prices, how that affects things, the crack spread, which affects their downstream profitability, and things like that. But until then, I think that it looks like Chevron has a pretty good business, although they are vulnerable to oil and gas crashes from a profit standpoint. From a value standpoint, it looks like Chevron is also quite good at $124 a share compared to even reasonable valuation multiples. One other thing, I also recognize that I didn't spend too much time breaking down EV to EBITDA. And I plan on doing one of the animation videos that I do on this channel because I feel that EV to EBITDA is a valuable valuation technique and it deserves a thorough explanation. And I didn't want to rush through it here today. So, if you've made it this far in the video, I really appreciate it. And if you haven't done so already, hit the subscribe button and don't forget to hit the bell so you can get alerts when we issue new videos. And thanks a lot for sticking around, and I'll see you in the next video. Thanks.